Hello, everyone. Thank you for joining us today. Today we're going to be talking all things ESOPs or employee stock ownership plans. On this slide, we've got our agenda, but really today we're just going to do a high-level overview of ESOPs as well as talk about some compliance considerations. A couple housekeeping items before we get started. After this presentation, you guys will get an email with the PowerPoint as well as the recording and also a quick survey for you guys to take. And then if you guys have any questions throughout the presentation, feel free to put them in the chat and we will check it periodically and make sure we get those answered for you before we are completed today. So to kick things off, my name is Aimee Werner. I'm a M&A director here at Lutz. My primary role is to help business owners buy and sell companies. So whether it be to third parties or, like I said, we're talking about ESOPs today. So we've been engaged to help companies sell to an ESOP, as well as we've been engaged by trustees to do some due diligence on a company that is potentially wanting to become an ESOP. I will hand it over to Kelly and let her introduce herself.
Hi, I'm Kelly Martinson. I'm a tax shareholder here at Lutz, and I work with employee benefit plan reporting. So I'm part of our employee benefit plan team, and primarily I'm looking at the tax issues, tax compliance related to those plans, and part of our audit team as well. So get in Form 5500 and those kind of things. We'll be touching on that later.
I'm Adam Cockerill. I'm an attorney with Koley, Jessen here in Omaha. I practice in the employee benefit space. So I work with employers on retirement plans and health plans, kind of anything and everything that touches employee benefits that may be offered to employees, executive compensation, non-qualified plans. And then specifically today, we work with a lot of ESOP companies, whether it's the formation of an ESOP to do a transaction to become an ESOP company, or just the ongoing administration of an ESOP, or ultimately potentially the exit, the sale of an ESOP company.
All right, so before we get into the meat of the presentation, I'm going to talk a little bit about succession planning. If you've ever attended one of these webinars or a presentation that includes our Let's M&A team, we like to hit on succession planning a lot. No matter how many times we talk about it, we still have companies and business owners coming to us when they're ready to exit today. And we like to hit home that, reality check, it's never too early to start succession planning. The best outcomes take time planning and also a little bit of money. I think making sure that you've got your replacement figured out, you have a good management team in place, making sure you have your financials in order. There's just a lot to think about prior to exiting your business. And so I'm going to touch on a few things. So a couple stats here: 3/4 of business owners profoundly regretted the decision to sell just 12 months after. I think we find that a lot of times this is when a business owner gets an unsolicited offer by maybe a third party, a private equity group, and they like the dollar figure and they say yes and move forward, but they haven't really thought about, hey, what am I going to do post sale of my business? Maybe they weren't actually ready to just retire. Maybe they didn't talk with a financial advisor about how much money they really needed to be comfortable in retirement. 70% of private businesses put on the market don't sell. If you don't plan or you do poor planning, you might put your business on the market, but that doesn't mean that it's actually a saleable company. 30% of family-owned businesses survive into the second generation, and by the time you get to the fourth generation, it's only 3%. So although a family transition might be the best answer for you now, eventually it's very likely that your business is going to transition to somebody other than family. 95% of M&A professionals believe an owner's unrealistic expectations of company value is the biggest obstacle to overcome before selling. And I don't necessarily know that it's always an unrealistic expectation, but a lot of times it's just they don't know. They don't know where to start, right? And so you need to talk with a professional to try to figure out how to figure out what the value of your company is. So a couple more stats. I don't want to read off of all of the slides, but it's a lot of business owners just aren't familiar with their exit options. One of them being, we're talking about ESOPs today, but there's multiple options to consider. A lot of people don't have a plan for the 5 Ds, which is death, divorce, disability, disagreement, and distress. And ultimately, like we said, you need to plan for your transition. You as the business owner, often you are one of the, biggest assets to your company. And so you have to have a plan to transition your knowledge, your skills, your relationships, your job functions, and that obviously takes time. So why do owners delay succession planning? Like I said, a lot of times we have business owners come to us when they're ready to exit now rather than talking about it, 5 years prior. And a lot of times business owners are just busy doing the day-to-day, job function of their business, running their business. And so it's easy to push off future planning down the road. Sometimes it's difficult to discuss. The unknowns are scary. Maybe, retirement scares you because you don't know what you're going to do afterwards. Other things that we find, it costs a little bit of money, but oftentimes your business is your largest asset. And so you do need to spend a little bit of money to get the best value out of your company. So here is just a slide. I won't read all of it, but it's some of the benefits of succession planning. Ultimately what we're trying to do is determine what the business owner has, determine what the business owner wants, explore your options for transitioning your business, and then decide which of those options is best for you. And then from there, we begin working towards that. And, it's okay if there's changes or that plan evolves over time. That's why we like to start as soon as possible. So there's really 3 primary options when it comes to transitioning your business. It's a transition to family, a transition to a third party, or a transition to employees, which is what we're going to touch on today with employee ESOPs. And then what does the business owner want? Ultimately, you want compensated for your business. Some people maybe want to continue running the business, but they want to diversify their estate. And like I said, your biggest asset is obviously your business. And so they want to diversify and not get that out of the business. Leave a legacy, maintain company culture, pay as little tax as possible, and then also pass on to employees and take care of your employees. And, all business owners want different things, but these are very common characteristics that we find. And there's some business owners that simply do not want to sell to a third party. And if some of these characteristics are something that you have and you are not wanting to sell to a third party, an ESOP is likely something that could be a good answer for you. So with that, I'm going to transition it over to Adam, and he's going to talk about some more characteristics of an ESOP candidate.
Yeah, thank you. And just to kind of highlight a little bit, we see in the Midwest kind of a lot more interest in ESOP transactions, and it's probably more just what I would call maybe the Midwestern mentality of they want to preserve legacy, they want to take care of their employees. They're concerned that if a third party comes in, maybe from the East Coast or something, that might have a material impact on the long-term view or long-term trajectory of the company and what could happen to the employees there. So we do see a lot more interest in ESOP transactions here in the Midwest. I'm going to take a few slides here. I just want to kind of give some real high-level ideas and concepts and discussion points with respect to what an ESOP is. There's a lot that goes into doing a transaction and selling your company to an ESOP, but we're going to touch on kind of some of the higher-level things to keep in mind. So the first part is just to kind of talk about what are some characteristics of a company that might be a good ESOP candidate. Obviously we need to have an operating company, a company that's got steady or growing earnings. There's no one size hat that fits all companies with respect to whether whether the company would be an ESOP candidate or not. But some kind of other basic concepts would be, we'd like to see the company have a fair market value of at least $4 million, 50 plus employees, a strong management team in place because they're effectively potentially moving the company forward and satisfying the ESOP obligations. Want to have some significant equity value, a lot of collateral in the form of assets, excess cash, and not necessarily highly leveraged at the time, because doing an ESOP transaction is going to create leverage itself. Kind of the way to think about it is, instead of selling to a third party, you're effectively selling it to your employees. And the consideration is going to have to come probably through leveraging, and that can be either through traditional bank financing or seller financing, or most likely a combination of both. Some good characteristics to keep in mind from a selling stockholders standpoint is, again, kind of that Midwestern legacy, or someone that wants to create a legacy for their company and not necessarily sell to a third party that could cloudy the future of the company. Someone that owns at least 30% of the outstanding shares of the company. They have a low basis in the company stock so that they can take advantage of some positive tax situations associated with a low basis in company stock. Someone with a significant personal net worth invested in their company stock. Again, someone willing to transfer ownership to employees and not necessarily a third party. And a lot of times it's a selling owner that wants the option to remain involved. So some of the basics, an ESOP itself is a qualified plan. It's a defined contribution employee benefit plan. It's governed by ERISA, it's governed by the Internal Revenue Code. So, all of you are probably familiar with your 401k plan and all of the associated rules that govern that. A lot of those same rules and then some apply in this situation, in an ESOP situation. The ESOP itself must be primarily invested in employer stock. The company, it can't be invested in other items. ESOPs, again, are primarily invested in employer securities. They're a qualified plan under the IRS. They're a defined contribution plan, subject to ERISA, subject to the Internal Revenue Code. It's a combination. It's a slight variation of a stock bonus money purchase pension plan. If anyone's familiar with those, we don't see a lot of the money purchase pension plans anymore, but it's a kind of a similar concept. And again, it's also the only type of employee benefit plan that can borrow money from the employer to effectively consummate the transaction. Some of the benefits of an ESOP for the corporation, again, it's invested in employer securities as a qualified defined contribution plan. So the ESOP itself and ultimately the participants in the ESOP, the employees of the company, end up owning shares in the company as opposed to a third party. It allows of borrowing from the employer to satisfy the obligations for the transaction. From an employee standpoint, you're effectively giving your employees ownership in the company, and so that creates a mindset that can eliminate or further eliminate turnover and unemployment costs. It can help facilitate management and employee transitions. It can be a tool, a motivator for management because they're going to have the opportunity to acquire ownership in the company through the ESOP. Again, it keeps jobs local, which here we see is very important to a lot of business owners, as opposed to maybe a strategic or a private equity third party that might have different designs as to what ultimately is going to happen to the company. It rewards loyalty to the employees of the company because they're going to start accumulating equity in the company, as well as new employees begin acquiring equity and accumulating equity in the company. It also can allow long-term growth through acquisitions. ESOPs can be used as tools in future acquisitions as well. Some of the benefits for a selling shareholder is the gain is potentially tax deferred. Won't really dig too deep into that, but for example, if you are a C corporation and you do a ESOP transaction, you've got the ability to defer tax on the proceeds that you receive from that through what's called a 1042 exchange rollover. It can be a good vehicle for succession planning, again, as a selling shareholder, a selling stockholder. It also gives you the ability to sell the company in stages. A lot of times when a third party comes in, they'll want to acquire 100% of the company at the time, or even private equity. This allows you to stage into it if you want. You don't necessarily have to do 100% sale of the company to the ESOP. You could stage in and sell portions of it over time. It allows the owner to have some ability to continue to control the entity during the process. They can receive warrants. They can stay involved with the management. It allows them to continue to effectuate some control and have involvement with the organization, as opposed to a third party coming in that might have different designs as to who's going to manage and lead the organization. ESOP transactions are, they're essentially confidential and less disruptive. It's not necessarily it's not necessarily a sale to a third party that might publicize it or have different ideas as to how they want to handle it moving forward. Again, it rewards employees for their loyalty. Those employees that have a long tenure and continue to have a long tenure after the ESOP transaction have the ability to acquire equity in the company over time. So it rewards their loyalty and commitment to the organization. Can create a legacy and maintain the company and the community. Again, that's a big thing that we see here, particularly in the Midwest. The desire to I won't say save the company, but preserve the long-standing nature of the company within the community. There's not necessarily the risk of a third party coming in and moving portions of the company out of the community and all the disruption that could come associated with job loss or things of that nature. But a stockholder can sell a minority interest. Again, kind of back up to where we talked about, you have the ability to sell stock in stages. It doesn't have to be 100% sale up front. And that also creates a second bite if it's structured appropriately through additional sale of the ESOP, through warrants, maintaining interest in the company if a third party were to come in eventually and acquire the company long-term from the ESOP. Some of the benefits of an ESOP for the employees is, obviously, again, the lower likelihood of the company being sold to a third party that might have different ideas as to the long-term plan of the company and its impact on the employees. Provides employees with a greater financial security for retirement. They're accumulating equity in the company through the ESOP. We just got done on the sale of a ESOP owned company that was 100%, that had, it was a very large and material sale, but it had some pretty dramatic ramifications to the employees. I mean, there was a large organization. The woman that ran the daycare within the organization realized $8 million out of the ESOP sale after the transaction closed. So you can kind of think through how it can really impact the employees on the back end, either through a potential sale one day of the ESOP owned company or just their retirement. They've accumulated shares in the company and the ESOP will have an obligation to buy them back. So it provides a lot greater path to retirement for employees than maybe your traditional 401k and retirement. It can provide greater involvement and pride in their company through a sense of ownership. Again, the employees start to take on an ownership mentality because they are accumulating equity in the company through the ESOP, which also then affects their ability to, it's a greater ability to affect their own personal wealth through their accumulation of shares in the ESOP, causes them to feel more like owners, which, affects them personally from a wealth creation standpoint, but also to better outcomes for the organization if the workforce as a relative collective whole is operating in the mindset that they own the company as opposed to just being part of the rank and file employees. One of the intricacies of having an ESOP is you get a fairness opinion, which is done by an independent valuation firm that sets the market, that sets the value of the ESOP at the time of the transaction. And then obviously there's ongoing valuations requirements that sets the annual stock price of the ESOP the shares that are held in the ESOP for purposes of redemptions and retirements and maybe ultimately a transaction. Some of the tax incentives for doing an ESOP transaction. Employees participating in an ESOP are not taxed on stock allocated to their account until they receive distributions. You can think about this in the same manner that you do with a 401k plan. All the contributions that go into a 401k plan, or in this situation, an ESOP in the form of company shares, they're not taxable to the employees at the time that they receive them. They're only taxable when they have a distribution event, when, if they retire or leave the company or hit the age in which they have to start taking distributions. They're not taxed until they receive that point, until they get to that point. Employees that leave the organization, just like a 401k plan, can roll over their account into an IRA and preserve that that deferred tax treatment. An employer can, within limits, they can deduct their contributions to the ESOP. This is going to be the case if it's an S corporation. We'll talk about that below. But a C corporation, when they're making contributions into an ESOP, they can deduct those as both principal and interest on the loans that are going into it, and just the allocations into the ESOP. ESOPs that are, this is kind of a neat thing about ESOPs that are companies that are S corporations that are owned by an ESOP, they effectively become tax-free organizations. All of the earnings can go back into the ESOP on a tax-free basis. So, moving forward, that company has a leg up on other organizations in the fact that it effectively becomes a tax-free organization. Again, some more slides on that for S corporations and kind of the advantages and power of being an S corporation that is owned by an ESOP is that it really does, it effectively creates a tax-free organization that the company itself does not pay taxes, as all of the distributions go into the ESOP on a tax-free basis, which allows for the repayment of the ESOP notes more aggressively or on better terms, because we're not having to portion off portions of the distributions and paying tax on that. Banks become more interested because they understand the ability of the leveraged ESOP and S corporation to meet their financial requirements. And again, once the ESOP transaction is paid off, the company continues to grow and generate tax-free income that can be used for further expansion and growth of the organization. So some of the things to talk about in using an ESOP and exit planning here's some of the steps. The first step is to just have a feasibility analysis performed, and that's a third party that would come in and do the feasibility of can this organization, are they a good candidate? Can they support an ESOP transaction? Can they support the associated leverage that comes with an ESOP transaction? There's a lot of factors and criteria that go into that, but it's essentially a feasibility study of whether this organization can handle and is a good candidate to be an ESOP. You want to hire trusted advisors. If you want to get a quality ESOP attorney, you'll have to have an independent trustee that effectively approves the transaction on behalf of the future participants. A good business valuation firm that can help navigate the valuation of the firm of the company as it navigates the ESOP transaction. You want to analyze the sales structure and all the options with the selling shareholder in the bank. You'll have an attorney that forms the entity, drafts the plan documents, and everything associated with the actual ESOP itself. So this process involves attorneys, valuation firms, and a trustee. Total typical fees for something like that can start at $100,000 and grow from there, just depending upon the size of the organization and the complexity of the transaction. Transition into polling question here, and then I'm going to hand it off to Kelly. We had one quick question come in about utilizing ESOPs to maybe acquire a company. Really how that would work in that setting is if you had, for example, maybe a group of employees within an organization that had an interest in acquiring ownership in the company, maybe there's a potential conversation between the management, the employee base, and the ownership of the organization to acquire the company via an ESOP. But really, if it's kind of just truly an independent person wanting to buy a company, there's probably not a lot that can be utilized from an ESOP standpoint to come in and maybe effectuate a transaction. That I'm going to turn it over to Kelly to talk a little bit about some compliance considerations on ESOPs.
Okay, thanks, Adam. So just touching on, what would be involved at the start, and some of that's been mentioned as Adam went through the slide on thinking about what steps are involved, who do you get involved. And one thing that was mentioned was talking about those plan documents that get drafted by the ERISA attorney, incorporating decisions on who's eligible, vesting, and so forth. So that might sound a lot like, if you're familiar with 401k plans, because remember, this is a qualified retirement plan. So it's in the same category, if you will, as 401ks in the sense of it's a defined contribution plan. It is a qualified plan, so subject to the laws that were mentioned earlier. So typically the plan documents are drafted by an ERISA attorney. It's not going to be like your 401k that a lot of those that we see are prototype documents. These are going to be truly legal documents setting up the plan. So that's going to look different. We'll talk more about, you'll see, you've probably gotten a sense that they're more complex than your typical plans. So the other part of it is selecting a third-party administrator, or TPA, as we'll refer to them in this conversation, to handle the record keeping and plan administration. And certainly best practice, as we've said, that's part of the discussion here, is you want a TPA that specializes in ESOPs. It's possible that it could be the same TPA that does 401ks, but quite frankly, you really want a specialist in this area because it's much more complex, the steps that need to be done. And so that's, again, highly recommended as a best practice. And then, of course, communicating the plan to the employees, how do the employees find out about it? Yes, you probably have a little more formal. This would be something new that they wouldn't maybe understand how it works as well. But certainly there's a summary plan description that should be distributed. And again, that might be familiar to those of you that are familiar with 401ks and what you communicate to employees. But I would say that in an ESOP situation, there's probably more of a formal announcement, because this is something that the owner's trying to really communicate to the employees and the benefits and all of those things. So you probably would see a much more, I'll call it formal.
Yeah, we see a lot. There needs to be a lot greater emphasis on employee education when an ESOP's implemented, just because it is different than your 401k plan, where it's probably kind of somewhat relatively easy to explain, like you contribute this, the employer contributes this, it gets invested in this lineup of mutual funds and whatnot. Here, it's really educating the employee base as to what it is, and ultimately that they are accumulating shares in the company. So the education component around an ESOP transaction is really important.
Absolutely. And as Adam said, because most employees may not be familiar with it, you certainly want to educate them. Some of the points that were made earlier about what are the benefits to the employees, what does that look like, what are they, why should they be excited about it? So all of that is part of that employee education. On this slide, I'm just listing some things that your TPA would be involved in, and this is not by any means an all-inclusive list. There's, as you said, there's a number of things that the TPA would be doing on a, not necessarily day-to-day situation, but throughout the year and on an annual basis. So this is just to highlight what we've said about hiring a specialist, that your TPA needs to be a specialist in ESOPs. They're much more complex than other defined contribution plans. And so this could very well be, a TPA that only works with ESOPs. But certainly you want someone that is well versed in them. I'm looking a little more at the annual compliance and reporting items. And again, we touched on the fact that you would have a valuation of the company to determine fair market value of the stock that's owned by the ESOP. So if you think about, on an ongoing basis, when you go to file the 5500, which is the reporting mechanism for qualified plans. So your 401ks fall in that bucket as well. But you have to have a value on what are the underlying assets in this plan. So if we had, think about your 401ks, you have maybe publicly traded stock, mutual funds, things that you could readily find the value of. Well, here we're talking about closely held company stock. It's not publicly traded. So we've got to have a valuation to determine what is the value of that stock for 5500 purposes. So besides the initial valuation when you put the plan in place, this is something that you would have on an annual basis. And so that, of course, then is part of the Form 5500 filing. And we mentioned that an audit of the ESOP could be required, and this is dependent upon the number of participants in the plan. And so the way that's looked at is at the beginning of the plan year. So let's assume a calendar year at January 1, how many participants did you have with a plan balance? And if that number is 100 or more at the beginning of the year, then the ESOP actually needs an audit, and that audit report gets attached to the 5500. So in that sense, could be similar to other qualified plans that you sponsor, but just be aware, that is going to be driven by participant counts. The summary annual report is distributed to participants once that 5500 is complete. It's really just a summary of the plan activity for the year, and it goes out to all participants. So that is something also that typically whoever's preparing the 5500, which typically your TPA, would also prepare the summary annual report for you to distribute out. And just mention one other thing, that valuation, that is a requirement whether you need an audit of the ESOP or not, because the 5500, again, think about why do we need that value of the stock? For this annual ongoing item, we need it for the Form 5500 filing. So we need to know what the value of the stock is to put on there, even if we're under the audit requirement of the ESOP itself. So you should expect an annual valuation when you put an ESOP in place.
And you also have to use the annual valuation for as participants accumulate shares over time and then begin to retire or separate service, the ESOP generally is going to have an obligation to buy those shares back from the employees, and we have to know what's the value that we're going to utilize to buy those shares back. So the annual valuation is really critical from a standpoint of 5500 filing, but also potential repurchase obligations when separations, retirements occur.
So I'm going to flip back to that, to the previous slide and just talk about the repurchase obligations with respect to what Adam was just saying, is that, yes, you have to have, this valuation is what's going to be used to determine that. So it's something that obviously a formal valuation being done so that you're using proper value for those transactions. And then thinking about some of the ongoing requirements that are out there, you would need to, much like any other qualified plan, you'd need to update plan documents when there are law changes. And that's something that, probably you'll have people that can help monitor that, namely probably the ERISA attorney and the TPA trustee might even be, if you've got good service providers involved here, they will probably be helping, communicate that to you. Monitoring and evaluating service providers. So, when you do choose someone and maybe you figure out that, well, I don't think this firm really does these, or we're the only one they've done, or whatever it might be, there is an obligation to make sure that you, to the best of your ability, to use a qualified service provider in these different areas, whether that's valuation, who's the TPA, the attorney, et cetera. And just a note too about fidelity bond coverage. So plans are required to have fidelity bond coverage for anyone handling trust assets. And typically the normal rule is 10% of your plan assets up to a maximum of 500,000. But when you have employer stock in the plan, then that goes to $1 million. So just something to be aware of. And again, that's something that you would be purchasing, I guess, at the beginning, shall we say, but it's something you would monitor then each year to make sure that you've got adequate bond coverage. And that is a question on the 5,500. So you are actually putting out there, yes, we have coverage and here's the amount. So it's very easy to see on the face of the 5,500 whether you have adequate coverage or not.
Thanks, Kelly. So I know we've got a little bit of time left, and so I guess Kelly and Adam, a common question that we get are there, trends and types of companies that you see becoming ESOPs? I know we see a lot of construction companies, but just curious what you guys see.
Yeah, construction companies. We're seeing more of it in the service industry, particularly like the engineering world. We've seen it in the accounting world now. A lot of manufacturing companies that maybe are closely held by a family and kind of have that desire to maintain, local ownership of the organization. But yeah, really kind of across it, you can kind of see it across a lot of areas.
I think most recently, I've seen it in what would really be in the construction industry, or at least a piece of that, and also service business. Adam was mentioning.
No, I would agree. I think that's the same from what we've seen. I always just like to talk about too, do you guys, Adam mentioned a success story when he was talking, any other, big wins for clients that you've worked with, or also maybe horror stories or pain points that clients weren't anticipating, but you guys came across?
Not necessarily on a specific level, but I probably couldn't emphasize enough that upfront feasibility study and working with kind of a valuation firm, because those are the groups that are going to really put everything together, because you have to keep in mind that in order to ultimately consummate closing on ESOP transaction, there's an independent trustee that reviews the transaction and blesses it on behalf of the participants effectively. So the cleaner you can have everything prepared ahead of time, because it will get scrutinized by the trustee, the better.
Yep. And I can kind of, tag off of that. We've been engaged by a trustee, and there was a particular transaction that the company that was wanting to become an ESOP didn't have reviewed financials, audited financials. And so they engaged us to do a sell-side quality of earnings to make sure that the financials were in good working order prior to the valuation being done. And, they were typically looking at cash basis financials. They had some receivables that were getting booked that weren't getting collected on. And what they thought was about a $45 million EBITDA company, when it was all said and done, was closer to a $3 to $5 million EBITDA company. So needless to say, the transaction did not go through because the valuation wasn't what the business owner was expecting. But, when we talk about succession planning and things like that, getting your financial statements in order is very important. And I know a lot of business owners maybe run some personal expenses through their financial statements to, for a tax savings, but what you're saving on that really is taking a larger value away from, the ultimate value of your company, whether you're selling to a third party or an ESOP. So just some things to consider, if you are going to become an ESOP, or really just any transaction, that making sure you have good financial statements. And then also, I know we talked on having a management team in place. It's always important no matter what type of transaction you do, but it's really important in ESOP because you don't have a third party coming in that maybe already has a management team that can come and help the company out. So making sure that you have a strong management team is key.
I think I know I touched on this on one of the slides, but I can remember a situation where a small company that didn't need the audit of the ESOP, but they didn't realize they were going to need a valuation of the company even to be able to do the 5,500. So that was kind of a shocker to them, because there's a cost involved that they weren't planning on.
Absolutely. So we're gonna check the chat box and we'll see if we've got any questions from participants and make sure we can get those answered.
There's a question about whether the S corporation rules for the taxability of earnings has ever been in question or jeopardy in the past. I guess, to my knowledge, no. I don't know if Kelly has any thoughts on that, but to my knowledge, no. As it would relate to an ESOP owned S corporation, I haven't seen anything
I would agree.
threatening that, I guess. And
I have not either.
I guess I don't probably see that changing with the new administration from that standpoint. They seem to be employee ownership advocates.
I can answer. There's one about fidelity bond coverage. So the maximum is $1 million. It's 10% of plan assets. That's the required amount. And there's a maximum level that if you hit the max, you're fine. Meaning, if you've hit the 10%, you don't have to have more than $1 million if you have employer stock in the plan. So the actual requirement is 10% of plan assets up to a maximum of $1 million when you have employer stock in the plan.
There's a question on if you've got multiple members of a family as shareholders, are ESOPs helpful? Yes and no. I think that, that's probably similar to any other transaction where you've got multiple owners. Can you get consensus on doing an ESOP transaction? No different than could you get consensus on a sale to a third party. So I don't know if that creates pros or cons other than just everything associated with an ESOP, but definitely doable. But also, again, it probably really comes down to probably the dynamics involving those shareholders.
Yeah. There's a question on what is the preferred method of determining the value of a company. Typically, we see a multiple of EBITDA. However, depending on the industry, sometimes you might see, revenue being utilized. But yes, EBITDA is the most common metric that we typically see.
There's a question regarding kind of the startup fees and costs associated with doing an ESOP. That can vary. That $100,000 number that we put, that involves multiple parties. You have your attorney, your business valuation firm, the feasibility study. That cost obviously increases as we talk about the size of the potential ESOP transaction. But yes, there's certainly that cost is kind of to do the transaction. There's certainly organizations out there that can come in and do maybe not necessarily evaluation, but just do some initial consulting for significantly less than that, just to try to help get everyone's heads wrapped around, is this something that we want to actually pursue and do? There's a question on the sale of the stock to the ESOP. Is it usually sold at a discount to the employees or at its face value? I guess what I've seen and be interested in your comments too is ESOPs have pros and cons. The pros are there's a lot of tax benefits associated with doing an ESOP transaction, the ability to preserve the legacy and ownership and everything associated with the organization. But we have also seen that sometimes ESOPs aren't going to get when you do an ESOP transaction, you're not going to maybe get the same amount of, call it a multiple of something that you would maybe get to a strategic buyer or a private equity organization. So there is a juggling act in terms of willingness to maybe potentially accept a lower value for the organization by doing an ESOP as opposed to an outright sale to a third party. But again, it's all contingent upon the facts and circumstances, but I think that's a fair rule of thumb.
Yep, I think typically we would see a third-party transaction to a strategic or private equity group. Oftentimes they're willing to pay a higher price, and the ESOP is getting a fair market valuation to determine the value of the company. Whereas, a third-party buyer, you don't know who it is. Each buyer values different things, and so some are willing to pay more, some are willing to pay less, so you might get a premium. So again, it depends. That's not always the case, but I would say that that's typically what we see. All right, we're just giving everyone a couple more minutes in case there are any more questions, but really appreciate everyone's time today. I think if you're here in Omaha, everyone got to pull out their shovels for the first time this season, so hope everyone stays warm. But as always, if there's any questions after this webinar that spark, please reach out to any of the three of us or your Lutz or Koley representative. We're always happy to answer your questions, and if we don't know the answer, then we're happy to connect you with someone that does. Yeah, appreciate everyone's time. And one last question, is the slideshow available for review? Yes, we will get that sent out through an email with the PDF PowerPoint as well as a recording, and then there will be a survey for everybody to fill out as well.